Hello everyone, good evening. Welcome to our YouTube session on Oracle Tax Reporting Cloud Service, that is our TRCS, and I'm really happy you are here. So today's session is brought to you in collaboration with the BISP Solution, a trusted learning partner for Oracle EPM. Big thanks to BISP for supporting continuous practical learning for finance and tax professionals. So what we are gonna do today is that today we all make a deferred tax crystal clear. So that will actually clear our understanding of deferred tax and the related concepts in TRCS, which will help us in automating the tax, right? So uh, what is we will start with that. What is it, why it appears, how the DTA and DTL arises, how different accounting frameworks handle. We can say that under the Indian gap or the US gap, etc. And a special Indian topic, donation under section 80G, which will actually tell us what are the partial payments made under actually the permanent difference. I will also connect concepts to how you typically model report them in TRCS. So let's get started with it. Alright, so simply we are gonna first start with that what is deferred tax. So deferred tax is the tax effect of time difference between the accounting profit and the taxable profit. In other words, that some income expense shows up in the books, but in tax in tax later it is not there. So the part of the tax is pushed to the future or pulled into the present. Here we can say that we can take an example, a very short example. We're gonna take a new sheet. For example, your company, this is company's books, and here we have tax books, right? So under the company books, for example, you have a depreciation of 10,000, but under the tax books you have a depreciation of 20,000. So there is a huge difference between these two, that is the difference of 10,000. So this is our DT, which we also call the deferred tax. Means it's actually according to the company's book, the depreciation should be 10,000 that we would be paying. So according to it, the tax provision will be according to the book, the tax provision will be 10,000, but actually you have to pay 20,000. So that means if you pay more in according to the company, if it's 20,000 here 10,000, you pay more, that means you have to pay less in future. But if the tax books is more than the company books, that means you have to, if you are paying less today and paying more in future. We will actually see it how it works, right? So we can say that the deferred tax formula can be that the tax expenses minus current tax we get from the company, and tax expense we will get from our tax books, right? Here is a actually good example. You can see here we have taken the revenue, which is all total. Let me bold. Okay, so under revenue we have dividend, interest and profit income, which we have all actually summed up here, right? So it is actually 15 lakhs, and here we have expenses, that is 6 lakhs, which consist of direct and indirect expense. So an accounting approach, if we have the revenue of 15 lakh whereas the expense of 6 lakhs, then what will be our profit before tax? But before profit before tax we have extra additional information, that is there is a machine of 5 lakhs, and we have a SLM, that is a straight line method, that we will be carrying out on a machine for 5 years. Then that will be 5 lakhs into 1 upon 5, as for each year we have to take it out. That will put us that will give us the amount 1 lakh, right? So according to the company's approach, we will also lessen the depreciation, that is 1 lakh. So the profit before tax we will get here is 8 lakhs, that we can say is our book profit or accounting profit, right? Under this we will calculate the tax, that will be the 30%, which will come to 2,40,000, which we will be lessening here from the 8 lakh, which will give us the profit after tax 5,60,000. Under this you have here the profit after tax, or the book profit you can say, or the tax, the current the tax the total tax expense here is 2,40,000. Here it is a difference one. So according to the income tax approach, first we will take, instead of this thing taking that profit after tax or profit before tax, you can actually redo it from starting, that you can take the revenue, then here you can take the revenue, right? In revenue you can have 15 lakhs, and here you can have 6 lakhs instead of doing this procedure. So I'm actually going with both the procedures, so you can have a better understanding that how actually it works, right? So under this, the income tax approach, it's the guideline that it will not be according to the SLM method, but instead it will be according to the WDV, that is the written down value method. For example, if you have a machinery that has a value of 10,000, then you have the WDV 10%, that means 10,000 minus 1,000, which will come to 9,000. Then again we will be charging a depreciation, but not on the 10,000 or the SLM, we will charge it on the new value at the 9,000, right? Then it will put us that 9,000 minus 900, that is a depreciation, which will give us the value 8,100, right? So in next, here we will go for the depreciation, lessening the depreciation. So here according to the WDV we have 1,25,000. So now here the taxable profit will be, under this we will calculate it, will be 7,75,000. Here you can also see it, right? This is the procedure that you can redo this whole procedure, or you can just take the profit before tax that we have taken right here, add the old depreciation that we have added, that is the SLM method, and then lessening the new depreciation that we have, that is a WDV, right? You can choose both the methods for it. So now as you can see that here the profit before tax or the book profit is more than the taxable income. Okay, so here actually that the accounting according to the accounting or the company's point of view, they are paying more profit, right? That means they will be paying less in future, right? They are paying actually more tax, that so that they will be paying less in future. So it is creating a deferred tax of 25,000. Here we can say, here we will put 8 lakhs minus 7,75,000, which will give us 25,000, which is a DT, right? Deferred tax. Here you can see the deferred tax. So here you will say it in a way like I have already told you that deferred tax, when accounting profit is more than the taxable profit, that means you pay less tax now, you pay more later. Or vice versa for the DTA. That means when accounting profit is more than the taxable profit today, you pay more tax now, but you will get a relief later, right? So this is the working right here. We have actually taken it for 1 year. You can see here the formulation that I have done. See, here we have the DTL, which is telling us that when account profit is more than the taxable profit, that means this section is less than the book profit section, then it is a DTL, right? Or here the account tax is more than the current tax, then it is a DTL. Then we will go to our presentation so that we can actually read the definition here. See, as I have made a chart also, that deferred tax equals a tax expense minus current tax, that is tax expenses according to the accounting and current taxes according to the income. So here the deferred tax, we have the same formulation. You use faster depreciation for tax, less taxable income today, you owe tax in future. You get a DTL, right? For the DTA, we have you record an expense in book this year, but tax laws allow it next year. The tax is more this year. Fine. So now we will move forward. So here we have actually in the presentation, recognizing these differences which arise from various factors including different treatment of income and expense under the accounting standards and laws. For example, we can say that if a company is actually registering a expense in today's, that is the 2nd of September 2025, according to the tax, if it closed the book on December, it only is allowed to only carry out the expenses which has been occurred within the year, not which is going to occur in future, but the company has registered a expense which will occur in future. For example, it will occur on November 2026, so it has actually registered it, but that as the tax doesn't authorize it, so there it will create a difference. That is the difference which we are talking about, the difference in treatment of income and expense under the accounting standard and the tax laws, as both standards differs and both has its own standards and authority over the sheet that the company make. So according to the company, it's right under the accounting standards, but according to the tax laws is wrong. So this is we are gonna work on. So the tax are postponed or advanced to future period due to temporary difference between the accounting income and taxable income. That means either it is postponed, that means it's in the past books, or it's advanced, that means it's the future payment that we are going to talk about, right? So here's a definition of the deferred tax liability. The deferred tax liability is a future tax outflow because you pay less today. We can say with the depreciation difference that we have just talked, the tax which was used faster depreciation, which slows the books down, right? We can also say that different type, like revenue recognition difference, recognized early in books but in taxes later, we can say it. And as for our DTA is that which will benefit you in future, that you can claim in future because taxable income was high, right? And your deductions were low. It can be any carry forward losses, like today's loss reduced future taxable income. For example, in this year you have a loss of 10,000 and next year you have 5,000 as your tax. So there is some proportion which is actually allowed you that could be deducted from the tax losses itself. We will take an example here. For example, we have a tax loss in the year that will be 2025, which was of 10,000, right? And next year you have a tax of 5,000. Under this, the tax authority allowed you to actually deduct the amount, let's say 1,000. So this from the tax laws under the 10,000, you will deduct 1,000, which will the tax loss will remain 9,000 after the deduction, and the tax will be lowered down to 4,000, right? So under this, you can also say that the provision and reserves are also allowed in accounting but not allowed in the tax until the later event. That we can take an example of actual write-off. These lower the future taxes, right? The classic example we can take under accounting is the provision for debt, as we actually make the provision before it occurs. Like for example, if we saw foresee uh, bad debt of 50,000 in future, so we make up provision for bad debt 50,000 in our book company accounts, but it is not recognized by tax authority, so we have to remove in the tax the sheet which is actually made according to the tax authorities, which will create a difference of that 60,000 or whatever the amount is under that provision for bad debt, right? Here we have recognition and measurement also, that the calculated deferred tax that applied a tax rate expected to be in effect when the temporary difference is reversed. Then we have the identify the temporary differences, that is the determining the difference between the carrying amount of assets and liability in the financial statements and their tax basis, right? You can also say that it emphasizes only on a temporary or reversible difference which create deferred tax, whereas the permanent difference never create DTA or DTL. We will cover an example shortly. We will go to our next slide. So under here we will actually adjust these all temporary differences according to these standards, right? We have the US GAAP, we have the Indian GAAP, we have the IFRS, that is our international financial reporting standards. We have the Indian AS. So we will starting with the US GAAP. We have the ASC 740, which is for the income tax, right? So it is based on the temporary difference. It's like IFRS. It emphasizes on the reliability of DTA, right? The recovery is doubtful, creates a valuation allowance to reduce the DTA, right? We can say it in a simple form that under the ASC 740 we ask, will we actually use the DTA? If not fully confident, we reverse via a valuation allowance, right? Now the next one is the Indian standard accounting standard 12, based on the temporary differences broader than the AS 22. Here the DTA on unused losses and credits recognized if probable future tax profit exists or not, right? The revaluation differences do lead to deferred tax under the Indian accounting standards, unlike the accounting standard 2022, which requires more disclosures. We will take example at asset in book 5 lakh versus a tax base 4 lakh. So the temporary difference here is 1 lakh. So the DTL will be of 1 lakh. Right. Now we will come to the IFRS, that is our IAS 12 income tax. It is also based on the temporary differences. It recognizes the DTA and DTL for all temporary differences except the initial recognition of goodwill and the initial recognition of the assets and liability in certain non-business transactions, right? We can take example under that is that the asset is 10 lakh, the tax base is 8 lakh, so the difference here will be 2 lakh, right? So the DTL will be here of 2 lakhs. So under the accounting standard 22, it is time difference. We can, and according to the Indian standard and IFRS, that it is for temporary differences. Just that the ASC under the US GAAP 740 adds a valuation allowance discipline, right? Then we have a reversible and irreversible. So here the reversible is a temporary difference we are talking about, and irreversible is a permanent difference. So the reversible actually creates the DTA and DTL, whereas the irreversible creates no DTA or DTL, right? So for example, we will start with the reversible one. So some income or expense appears in the both books and taxes, just in different year. We have already talked about the depreciation and the bad debts, etc. Examples are like depreciation mismatch, provision for doubtful debt, and etc. We can also take that like for the in early years, there was a tax depreciation was more than the book depreciation. Here the tax depreciation is I am referring to the, according to the tax authorities, what was the depreciation. So according to the tax depreciation, it was more than the book depreciation, so DTL builds, right? And in later years, if the book depreciation was more than the tax depreciation, then the DTL unwinds, right? So uh, what it means is that when the DTA is actually created after the DTL, it will be reversed from it, that it will be deducted from it or adjusted in it, right? So the next one we have is irreversible difference, that is the permanent difference we are talking about, where it is it have no DTA or no DTL, right? So items never allowed in tax ever, or allowed only partially with no future makeup, is only allowed under this. Alright. For example, donation not fully allowed. Under this we are actually gonna study that the section 80G, that is the partial case. We can say that the other examples are penalties and fines, the entertainment expense partially disallowed. So these are the permanent differences. So they are the effective tax rate, but no deferred tax entry. Name one permanent difference you have seen penalty. You have actually seen, except penalty, club expense or donation. These are some of the common actually examples that we are going to take. So here we have an example under the donation not fully allowed. Here you can see that the book has the company donated 1 lakh booked as the full expense, but the tax only allowed 50,000. So the extra 50,000 will never be allowed in the tax, right? Under the penalty, 20,000 is paid at the penalty to income tax. It is actually a booked as expense in the in our accounting book, but according to the tax book, it isn't allowed. So the 20,000 is never recoverable through taxes. And entertainment expense is partially disallowed. So some part of the business may be fully booked in books, but partially allowed in the tax. Then we will come to our next page, that is our actually partial payments. So we will take actually it's a example of donation under the permanent or the irreversible difference, right? So under section 80G there are different types of deductions. For example, there is a type where it is there is a 100% deduction without the limit, 50% deduction without limit, 100% with limit, and 50% with limit, right? So these actually depends on what type of donation you have made. So here you can see it, the 100% without limit is under the PM Cares Fund, National Defense Funds, whereas the 50% is under the Prime Minister's Drought Relief Fund. And here you can see that the 50% with limit is under the donation to approve NGOs and different trusts. So here we will discuss with the type 1. For example, 100% without the limit. So here is no restriction, the full amount is deductible. For example, here we have the donation. One lakh. Right, and we have tax, you can say 2 lakhs. So now the 1 lakh is fully deductible under that from the taxes. So if it actually the new tax, what will come here will be 1 lakh. Right, after we deduct the donation from the tax, we will have the new tax, which is 1 lakh, right? Next we are gonna get to the next answer, that is 50% without the limit, meaning here the donation is 1 lakh, but only it is allowed 50%. That means the 50% of donation here will be 50,000, right? So under the tax, if the tax is 2 lakhs, we are gonna get the new tax, that is 2 lakh minus 50,000, that is our 1,50,000, as it is actually partially allowed. Then it is also that it is not allowed to be deducted also, right? So here are the 3 ways, and we are going to actually carry out 2 more, which is the type 3, that 100% with limit, right? So we will go to it. Here we have actually taken the 10% only, but up to 10%, right? For example, we have here the 10%, right? Then that means the donation, that the deductible amount out of tax or any amount from the GTI which we are gonna actually deduct it is this much, 20,000. We are only allowed to deduct 20,000 out of it, right? For example, we have a donation of 1 lakh, right, and we have to deduct it, but under this GTI we are only allowed to deduct it out of 10%, that is 20,000. So we are only allowed to deduct 20,000. The rest 80,000 is actually that means the rest for 80,000 is allowed, what you can say here. Here I have taken the example of government hospital for family planning. You can share that the adjusted GTI is 6 lakhs, but the limit was 10%, that means 60,000. So the donation was 1 lakh, so only 60,000 was allowed. So under this we are gonna go half. Okay, so now under this, that if it is half, that means it's 50%, right? Again we are gonna take the 50%. Then that means the new donation will be, that is allowed in the books, is so actually some error has actually happened here, so we will actually just take it that 50,000 is only allowed right here. So the 50,000 is allowed, so only 20,000 is deductible, so the rest 30,000 here will not be deductible from it, right? So this was actually our partial payments which we have talked about. There will be different partial payments which will be deductible under that the permanent differences. So I have just covered this part, right? So now for a big, we are going to take a big example, like a 5-year example, which will help us in getting a in-depth view of how that deferred tax work, right? So we'll go, we have a here 5-year plan right here, you can see. We'll just zoom it up. Okay, so we have the revenue of 2,50,000. Here we have the expense of 50,000, under which the direct expense is 25,000 and the indirect expense is 25,000. Under revenue we have a dividend of 25,000, we have an interest of 1,25,000 and profit of 1 lakh, right? We have here that the tax will be at 30%. We have a provision for doubtful debt right here. Instead of depreciation we are taking something new, that is a provision for doubtful debt, right? So we have here, that is year 1, year 2, year 3, year 4 and year 5, that is a total actually provision for doubtful debt. So we are going to take this amount and we are going to put under this. right? And we have a provision for doubtful debt, that is our 10,000, right? So we will put 10,000 right here. Now what will be our profit before tax? So our profit before tax will be this minus 50,000. We will put minus 10,000. Right, that means we have a profit before tax of 1,90,000. And what will be the tax on it? So here we are gonna calculate the tax. The tax will be of 57,000, right? So what the profit after tax will be our 1,33,000. But this was according to the accounting approach. But if we use the income approach here, what we can see is we have a profit before tax that was 1,90,000. We will copy it. We'll paste it right here. This 1,90,000. Under this we are gonna add the provision that was 10,000. Then we will have a taxable profit that was 2 lakhs. Under this we will charge tax on the 2 lakhs, that will be 60,000, and the profit after tax that we will give is 1,40,000. So under this we can see here that here the tax is actually less than the accounting tax is less than the income tax tax. So what we are going to create here is the DTA. As you can see, if we minus it from this, we are going to get a negative value. That means it is actually creating a DTA, as the taxable profit right here is less than, is more than the accounting profit, right? Or you can say that here the accounting tax is less than the current tax. So what we have here, we have the deferred tax, right? So here we can say that the 3,000. Now in the next one we are going to put the same values. Let me first put the same values in all the ones, so we can actually get it in an easy way, right? So under here then we have actually 12,000. So we're gonna put 12,000 right here. Then we will actually deduct all the expenses, that is our expenses and less provision. We get a profit before tax of 1,88,000, on which we are going to charge our tax now. So here we have a tax of 3,600. Okay, I have taken the wrong value, so we will take this one. We have 56,400. Now we will take this value right here, we'll put it right here. Okay, actually that is derived from a formula, so I have to actually manually put it. Alright, now we will add the provision that was 12,000. That will give us 2 lakh again, on which the taxable profit will be same as 60,000. So here again what is the difference? So we will calculate it out. This minus this, that will come as 3,600, right? So here again there is a DTA, because the accounting profit is more than is less than taxable profit, and the accounting tax is less than the current tax. We are gonna keep doing this till we get a DTL, right? So under this, let's get 8,000, 6,000 and 4,000. We'll put all the values: 8,000, 6,000 and 4,000. Here we will add it back, so we are going to put the same value and 4,000. So let's continue. Alright, under this we have the profit before tax. We are going to calculate it. That will be 2,50,000 minus 50,000 minus 8,000. That will give us the book profit of 1,92,000, under which we are going to calculate the tax on this into 30%, which is 57,600, right? Gonna put the profit before tax right here, and then we are calculating the new taxable profit. That will be 2 lakh, on which it will be 60,000. So under here we have again a DTA, as the accounting approach or the book profit is less than the taxable income. So we are gonna create a DTA. So here we are gonna calculate what is the amount. So we are gonna put this minus this. So here we have 2,400, right? The difference is of 2,400. So here the deferred tax asset, this is ET, right? So we're gonna, this is a deferred tax asset. Actually it will all be added, as this is the 3,000, then we will, what will be the total? So here it will be 3,000 plus 3,600. That will put us a 6,600. Then it with this, we till here we have it. Then we will add on 6,600 the 2,400 plus the 6,600. So the total DTA till here is 9,000, right? Now we are gonna come to the year 4, where we have the provision of 6,000. Then we will calculate it. Then the tax, we have 58,200. Then we will put 1,94,000 right here, under which we are going to add back the provision. Then the taxable income here will be 2 lakh, under which we have the 60,000 as a differences. So again we have a more deferred tax. That means it is a DTA. So here we are going to calculate it. Here it will be this minus this. So here it is 1,800. We are going to add it up, but what is the total till now? We got it 10,800. Then here we have 4,000, right, as a provision for doubtful debt. So we are going to calculate what is the taxable income, the accounting profit, on which we are going to calculate actually the tax minus expense from the revenue, and then lessen the provision for doubtful debt. That will give us 1,96,000. So here we are going to calculate the tax on it, 30%. That is our 58,800. Under this we are going to add again. This will give us 2 lakhs. We have 60,000, So again it is the accounting actually profit or the accounting tax is less than the taxable profit or the current tax. So here we are going to create a DTA. So under here, which will give us 1200, and what will be the total DTA till here? We are gonna add it to the 10,800. We have 12,000, right? So here you can see that total DTA which we have created were the total provision for doubtful debt was 40,000, right? Now, as for 5 years we have made it. Now in the 6th year, the bad debts actually occurs, right? So here we will have no. Here we will have no entry, right? So because we have actually recovered it. So here we have on which we have a tax of 30%, that will be 60,000. But in the income tax approach, if it is occurred, so instead of lessening it, we will instead of adding it, we will less this time. So all the provision that were actually accumulating to 40,000, right? So here the profit before tax is 2 lakhs, under which we are gonna deduct 40,000. That's actually occurred after 5 years. Then what will be our taxable profit here? So here we are gonna get the taxable profit by deducting the provision for doubtful debt from the profit before tax. Here we get 1,60,000, then we are going to calculate the tax on it. Here's the tax, that is 48,000. So this time the accounting profit or the accounting tax was more than the taxable income or the current tax here, right? So we will create here a DTL. Right? So what is the liability right here? It means the deferred tax liability. We will deduct it from this. It is 12,000, right? So here you can see that we have created the DTA till here was 12,000. So we are gonna deduct this from our DTA. That means here till this point the DTA was 12,000. Now if we deduct, then it will get 0. As 12,000, we are deducting 12,000 for 12,000. Here under this you can see that the accounting profit was more than the taxable profit. Under here the accounting tax was more than the current tax, so we have created a DTA. So this is how we are going to do the automation in our application. So here is our application. Now we are go on the application, right? We are first gonna make 3 duplicate tabs so that you can easily understand that how and what we are gonna do under the tax automation. So we are gonna go under our tax national provision under the package. On the last one we are gonna go on our source, that is a library from where we are gonna actually pull the data. Book data, balance sheet by source. Under this we are gonna go on our application, and under the configurations we will let it load, or we can just refresh it up. It's gonna land us on the home page again. Then we are gonna again navigate. Let's go one by one, and as it isn't loading it, we will go in the current provision. Now the next one we have here is we are gonna go on the configurations. That will be under application, tax automation. Then under this we are gonna go on our book data. We have already opened it here, so it's showing us, right? So here is all the data that you have actually feeded it here under this, right? Instead of US domicile, we will take the known jurisdiction. We will have the data right here. Okay, this is all the data that we have under here, right? So for this we have to actually pull the data or put the data here. Then we will pull the data through the configurations that for here you can see that the meals and entertainment and other things that we consider under the tax, and we are gonna put in this form right here, right? We can see here the meals under the total temporary differences.